بسم الله الحمد لله والصلاة والسلام على رسول الله. Assalamu alaikum and welcome everyone to this session where we will be delving deep into the legal aspects of startups, and also we have a guest from Adl Advisory, brother Mohammad Mishal. So he will delve deeper into the different contracts of the startups and also the VC. So yeah, without further ado, I would like to pass the floor to Mohammad Mishal.
Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you, HASAN VC team, for the opportunity. And I'm happy actually to share this session with the esteemed participants. Inshallah, it will not be it will be a quick introduction, and I'll try to make it as practical as possible. We will move away from theoretical discussions for the benefit of everyone, and I know you guys are practical people, so I wouldn't waste or I wouldn't spend much time on theory. However, just a quick introduction. When we enter into a startup as founders, as partners, we enter into musharaka from Sharia perspective, and Allah subhanahu wa ta'ala said in the hadith al-Qudsi of the Prophet sallallahu alaihi wasallam, أنا ثالث الشريكين ما لم يخن أحدهما صاحبه فإذا خان خرجت من بينهما. So basically this could be translated that Allah subhanahu wa ta'ala is the third partner of two partners, as long as one of them doesn't cheat his companion or his partner. If he cheats, then Allah subhanahu wa ta'ala will leave them alone or depart from them. Generally, when we talk about clauses and legal terms in Islam, the default ruling is that it is allowed, based on the hadith that المسلمون على شروطهم إلا شرطا أحل حلالا أو أحل حراما أو حرم حلالا. All conditions, أو كما قال صلى الله عليه وسلم, all conditions are allowed except the condition that prevents which is permissible or allows which is impermissible. So this is generally the ruling on all clauses. In all clauses, the default ruling is that it's allowed. However, all clauses, even without having a legal clause, when you enter a partnership, there is a limitation. There is a limitation by default. And even when we enter into, let's say, unrestricted agency or unrestricted contract, all of these contracts, when they involve agency, because partners are agents of one another, when they involve agency, even though they are not limited by legal clauses, they are limited by the interest of the partnership and the principle. So this is even from Sharia perspective. Whenever you enter into a contract, the default ruling is that you may act even if there's no restrictions on how you act. However, there's a default restrictions on acting based on the interest of the partnership. And this, these conditions or these limitations that are not written, they appear in clauses such as vesting clauses, M&A clauses, including the drag along, tag along. We will, touch base on these clauses when we move further. However, it should be always kept in mind that even from legal perspective, the partner or the manager should act in good faith. So even if you follow the letter of the law and the letter of the contract, you would still be held accountable to act in good faith. So that's the basic foundation. However, when we move into partnership, keep in mind that Allah subhanahu wa ta'ala is with you. He will put barakah in your endeavor, in your business, as long as there is no cheating. So when we discuss musharaka, I want you to understand these three principles. We will apply them to legal clauses. However, if you understand these three principles as a founder, as someone who is in the ecosystem of startups, you will be able to tell almost 85% of the Sharia compliance of the clauses. You would be able at least to eliminate 85% of the Sharia non-compliant clauses. Of course, you would need an expert, as we can see, but however, once you understand these, you'd be able without referring to anyone, to tell that this is not a Sharia compliant condition or clause. The first one is that losses should be shared according to capital. So whenever we enter into a partnership, we know that I own or I contributed 50% and my partner contributed 50%. If a loss occurs, then it should be shared according to losses. Any clause against this in the contract is not allowed. However, there is an implication of this ruling. What does losses, what's the one of the implications of sharing losses according to capital contribution means that capital contribution should be known. If you don't know the capital contribution, you wouldn't be able to know the how losses should be shared. So this is the first principle. We will apply it later on, and I'll ask the participants to actually contribute. Secondly, there shouldn't be any clause in the contract that would or that might deprive one of the partners from the profit completely. Now, what does that, what I need you to focus on is the word might. It's not necessarily it will deprive one of the partners from the profit, but it might. There's a condition on the way to dispute profit, to share profit, that might even theoretically or like mathematically might lead to one partner taking profit, the other partner doesn't take profit. If a situation occurs or a clause would result in such a situation, then such clause is not allowed. We will apply it nonetheless, but this is an important ruling. Thirdly, there should be no capital guarantee and not co-capital guarantee. It should be no capital guarantee. So we don't guarantee capital, and by extension, we don't guarantee any profit. So any clause would result in this, it would not be allowed. Now, the Sharia basis for these rulings, as I mentioned, I don't want to go deep into theory, but these rulings are very well established and accepted worldwide. So if I may ask, now these are the the terms that I want you to apply the rulings to. I'm not sure if we can take participants, but remember these three rulings: loss according to capital, no partner is deprived from profit, and no capital guarantee. A, B, and C. The answers are there, sadly. So I'll just do the answers myself, but try to be engaged and focus on how we apply these principles to very common legal clauses in the VC ecosystem. The first one is the liquidation preference, which is even if it is 1x, 2x, 10x, regardless of how many x the liquidation preference is, it is not allowed in Sharia. I will not focus also on the legal definition, as long as it's understood. General liquidation preference: when the company is liquidated, certain partners, pref shareholders, will receive their capital contribution first before other partners. And that capital contribution that they receive, sometimes it's not just their capital contribution, it's their capital times 2, times 1.5, times 3. So this liquidation preference is not allowed. Why isn't it? It's not allowed because it violates principle. I'll keep going back and forth. Loss according to capital. We don't share losses according to capital. You received your capital contribution first, and then other partners receive their capital contribution or their equity or the equivalent of their equity later. So you might share your full capital contribution, but others doesn't share it. So losses are not shared according to capital. That's why it's not allowed. Another common term in VC and startups is the fixed dividend, because mainly when we raise funds or they raise funds, they raise it based on pref shares, and pref shares have a certain percentage commonly. That certain percentage is a fixed dividend. Why isn't it allowed from Sharia perspective? Because it might lead to one partner being deprived from profit. Let's give an example. Let's say for this year you generated let's say 1 million let's say, let's keep it a percentage. Let's say you generated 10% ROI, and that 10% is fully distributable. The others expenses or like provisions you've already made, and 10% ROI on investments or on equity are generated and ready to be distributed. However, because you have committed to pref shareholders on like let's say 20% or 15% fixed dividend rate, that 15% fixed dividend rate ate up all of the 1 million or 10% ROI that you've generated. So nothing was left for the founders and the other ordinary shareholders. What happened in this case? The pref shareholders took profit. The other partners, ordinary shareholders and founders, didn't take profit. This is a condition that would result in one partner being deprived of profit, or might result. Now, you might say that in other situations, or in most situations, there will be profit enough for everyone. But as long as there is possibility from theoretical or from mathematical point of view, it would not be allowed. Third condition that is also existing in startups is the redemption right. The redemption right is the commitment of the company to, or the option of the company to buy back the shares from the shareholders or from the pref shareholders. Now, this is allowed as long as the amount of redemption, the redemption value is not fixed. If it's fixed, which is the usual, I mean, usually it's fixed, it's not according to market value. However, if it is fixed, then we fall into the third, or we violate the third principle, which is no capital guarantee. Because let's say the startup didn't do well after 2 years, when the redemption time was when it was the time for redemption, it didn't do well. The value of your equity or your investment have actually depreciated. But because of this redemption right or redemption commitment in this case, the company has to buy back based on a fixed value that would give you the that would amount to a capital guarantee. So and a profit if in case the redemption value was higher. If there's a question, you can ask. Otherwise, I'll just continue through these anti-dilution. Anti-dilution, there are many mechanisms. Some of them are Sharia compliant, some of them are not. Now, when anti-dilution is done through the right of first refusal or preemptive rights, basically, when anti-dilution is done through a legal clause that would give the right to the shareholder, to a specific shareholder, to buy additional shares when the company is issuing new shares, or when one partner is selling their shares. So that's the right of first refusal. This is when a partner is selling their shares. Preemptive rights is with the company issuing new shares. So some partners are given the right to purchase these shares first on pro rata basis, meaning that when these shares are offered, they can purchase shares according to what they own, and sometimes even the company has to offer them the amount of shares that would maintain their equity ownership. Let's say I own 5% in a company, and I have this anti-dilution right, the right to purchase shares whenever there's an equity financing, there's a funding round, or there's fundraising. Whenever the company issues new rights that might dilute me, I have the right to purchase shares that would ensure that I maintain the 5% ownership. So that is okay. That as long as we don't fix the value and I have the first right, I have priority to purchase shares before others, or before other partners or other non-partners like third parties, then that is allowed. However, there are other ways to ensure anti-dilution. One of them is the downside protection. Downside protection is also common in startups. Basically, a startup, an investor comes in and requests the company to give them a downside protection, which means that I agree on the value of your company now. Your valuation, let's say, is 10 million or 20 million. I agree on that valuation. However, if in the next funding round your valuation falls down. I purchased 20% equity in your startup, and we agreed that the valuation is 10 million. However, if the next funding round, your valuation fell down, your valuation was lower than 10 million, then I maintain that 10%. You will give me additional equity, you will give me additional shares to maintain that 10%, even after the down round, let's say the down round, the round where where your valuation was lower, and I got heavily diluted because your valuation is lower. It's not just you issued new shares, you issued new shares at a lower valuation. Now, in this case, we have three scenarios. The first one is an absolute guarantee. I mean, there is no restriction on this clause. There's a downside protection. If the valuation goes down, then we will issue additional shares to maintain your to give your equity the right. Actually, it's not the you will take additional equity based on the lower valuation. Let's say the next round, I mean, just to ease the mathematics, the next round was the pre-money valuation was 5 million, and I have owned previously 10% or 20% in a 10 million valuation company, which means that the company was valued 8 million pre-money. Let's make it 4. So I'll take the double. I'll take 40%, and now I'm ready to get diluted. But however, I gained a higher equity ownership. I hope I didn't confuse with the downside protection. If someone has a question on downside protection, you may ask me from Sharia perspective or even from legal perspective. However, I hope Brother Akhtar will make it even clearer. So if that's absolute guarantee, then it's not allowed because it violates principle number 3, no capital guarantee. If it's, however, because in Sharia we always want to understand why these conditions, why these clauses exist, and we understand this. We know that they're there for the purpose. We understand the startups culture, and we know why these conditions came into or why these clauses came into existence. However, while we acknowledge this, we acknowledge that the way that they deal with these challenges and problems in the startups are not always fully compliant. So sometimes we need to tweak it. So such protection is allowed if the lower valuation was due to negligence of the managers. So because they were negligent, or they have breached the terms, they have acted not in good faith. Because of this, the valuation was lower. Then in this case, we might have a downside protection, or we can have a downside protection, or actually, even without having this condition, you can go to a court that understands law and Sharia, and they can protect you. Another situation when it's based on a misrepresentation. If the founders misrepresented their company in a way that showed that their valuation is higher, in a way that the industry experts understand that this is a misrepresentation. We understand that valuation of startups, it requires a lot of, or it takes a lot of assumption and subjective takes on the startup. That's not misrepresentation. Misrepresentation is when you fraudulently represent your company to show that it's higher than it actually is. So in this situation, also a protection or downside protection is allowed. Lastly, convertibles. Convertibles is when you enter as a debtor and there's an interest. That's definitely not allowed. If there's no interest, however, you can convert in the future based on a similar to redemption rights, but this one is the right of the investor to convert into equity. If the value is fixed, which is commonly fixed, then it is not allowed. If it's based on if it has any incentive, then it's also not allowed because you attach a benefit to a loan. The convertible is a debt, it's a loan. If you attach a benefit, whether it's a valuation cap or a discount to this loan, then it's قرض جر نفعا. It's a loan that attracted benefit, and any benefit that a loan attracts is not allowed if it's conditional. It's a clause in the agreement. Safe is a is an interesting instrument. I wouldn't go very deep into SAFE. However, I will just mention one thing that relates to SAFE. SAFE doesn't agree on SAFE. You don't agree on a valuation of the company. You agree on a valuation, cap, discount, most preferred nation. You agree on different terms. However, you don't agree on the company's valuation for whatever reason, because you don't want to spend the cost or the time to negotiate the valuation, or because, I mean, that's basically speed, or because the startup doesn't have the numbers to actually back any valuation. The numbers are still very limited. You don't have revenue, you don't have user base. So in this case, it's not allowed. Why? Because of the first thing, losses according to capital. What's the problem with SAFE? You can't share losses according to capital because capital is unknown. We don't agree on a capital. We can't share losses according to capital. How does SAFE resolve this? They have a liquidation preference, and liquidation preference is also not allowed. Now, something that I mentioned in the beginning, control clauses are generally fine as long as it doesn't force the partner into non-compliant transaction and it's exercised in good faith. We have touched base on this. Lastly, as I mentioned, if you understand these three principles, 80% of your, or 85, you can eliminate 85% of Sharia non-compliant clauses. However, as a startup, we understand how the legal terms work in startups and why do they exist. And we understand that many of these legal terms have implications that even some startup founders don't understand. We have advised startup founders on certain terms related to certain legal terms from Sharia perspective, and they can't understand the implications, the economic implications of these terms fully. I'm not saying completely, but fully they can't understand it. And that's why it's eminent on both the startup founders and the Sharia expert to really understand the implications of these terms and don't take them as face value. You need to do the calculation. You need to do many scenarios to understand how these terms reflect in the future or might reflect in the future. And that's why, even though you understand these terms, it's better to always have a Sharia advisor when you conduct fundraising or when you conduct your business generally, but especially when you conduct fundraising. For example, the pre-money and post-money valuation, it has some implications. The way how capitalization of the company is calculated based on post-money and pre-money is not always defined. It's not always the same. It's different from one scenario to another. And these differences, and I think Brother Akhtar will also touch based on how employees option pool works, and also in both valuation mechanisms, the employee option pool has different role, and it's defined usually in the capitalization term in the legal sheet, in the legal contract. Also, when we talk about M&A transactions, in merger and acquisition transactions in in startups, we have the drag along, tag along rights that are usually laid out in the shareholder agreement. We have squeeze out and sell out rights. These are even sometimes they are defined in the law. That squeeze out, basically, it's the right of the majority shareholders, and usually it's 90%. The owner of the 90% of the company has the right, based on the article of association of the company, to purchase the minority shareholders' equity. So he will be the sole shareholder. This is different from drag along. Drag along is when you sell. Squeeze out, it's an internal agreement. It's an internal agreement. That's why it's in the article of association document. Sell out is the other way around. When the minority shareholders forces the majority shareholders, which is someone who owns more than 90%, to buy them out. To buy them out. So they said, for example, I'm a minority shareholder. I own 8% in the company, but I don't want to continue with the majority shareholder making all the decisions. Let's say for a reason related to Sharia, this majority shareholders want to enter into Sharia non-compliant activities or businesses, or because I don't trust his decisions. We can have in the article of association a sellout clause. Sellout means that I can force a majority shareholders who owns more than 90% to purchase my equity based on terms. So all of these terms, earn out is another acquisition clause. Earn out, basically, we define a price for your company, or we define a valuation. However, the payment is staggered into or through a few years. Let's say through 3 years, and the price is not in installments. The price it's in installments, but it's not fixed. So after the first year, we will look into your company's performance, specifically the EBITDA. And if the EBITDA is according to what we have seen at the time of the merger or acquisition, it's according to a certain parameter and what we expect your performance to be, then we will pay you the agreed upon price. If it's lower, then we will reduce the price by 10%. I mean, it will correlate with the EBITDA performance, with your company's performance. Earnout is also another mechanism that needs an expert to understand how it works, and then what are the Sharia implications of it. Vesting conditions, also, vesting is not always the same. Brother Akhtar will go into details and how vesting have different types, with a cliff, without a cliff, and how many years. All of these things need an expert to first understand their implications, and then to have the Sharia knowledge to apply to these terms. Wallahu a'lam. I think exceeded the time, but hopefully I have given a good foundation for you to understand what is the Sharia implications or the Sharia perspective on these legal terms. To understand these legal terms even deeply or more deeper, and which is the first step actually to have a Sharia ruling. I'll let Brother Akhtar take over.
Jazakallah khairan, Brother Mishal. There is one question in the chat by Brother Shadir. There should be no gharar, uncertainty, in terms of Sharia compliance. Does that mean all operational costs, including salaries, must be approved in advance by the founder and investors?
It's not clear to me. I mean, salaries, costs.
Brother Shadir, maybe you can unmute yourself and elaborate the question.
Sorry, this is noisy now. I think we don't allow to uncertainty in Sharia compliance.
Brother Shadir, sorry, we cannot hear you properly.
Anyway, allow me to address this from general perspective. Generally, uncertainty is not by default not allowed. Uncertainty has 4 conditions to invalidate a transaction. And one thing we should the differentiation that I want everyone to have, and sadly it's always mistaken. It's to differentiate between uncertainty related to contractual terms or contractual uncertainty and business uncertainty. Business uncertainty is, in Arabic, we call it khatar al-tijara. It's the risk that you take when you enter into any business or venture. When you enter into any business or venture, there is a lot of uncertainty. And the higher the uncertainty the higher the return it might be. And that uncertainty doesn't have any Sharia restrictions on it. You can take risky ventures, you can go into risky business and make profit or make huge losses. This is not, there's no Sharia restrictions. So previously in the past, they used to travel from one country or from one land to another land using camels or using the sea, and they used to say that whoever does that, then their money, their wealth is at risk. And some investors, they condition that you don't, like Al-Abbas, the uncle of the Prophet ﷺ, he used to tell the fund manager that if you take my fund, then you shouldn't travel with it, or you shouldn't buy any living being with it. You shouldn't trade in living beings like animals and cattle and all of these things. Why? Because they have higher risk. However, from Sharia perspective, there is no problem with higher risk from business perspective, and this is actually a required. This is we call it الضمان الخراج بالضمان. So whatever comes from the whatever benefit you yield from an asset, an investment asset, you should bear the liability that relates to this asset, and that liability might be very risky, and the uncertainty is definitely going to be one factor of it. The gharar that we refer to, and many people sadly confuse gharar with the khatar al-tijara, with the business risk. The uncertainty, it relates to the way that you contract. It's a contractual uncertainty. What does that mean? It means that I didn't define the subject matter of the contract or the price. I didn't define the period. So these are related to, I entered into a contract where the outcome or the counter value is uncertain. So a common example is insurance. You pay the premium, however, the benefit of the insurance is uncertain. So the counter value is uncertain. Even the value of the counter value is uncertain in insurance. Your benefit might be 10,000. It's according to your damage. So all of these factors are contractually uncertain. I gave you the premium, but I'm uncertain that I will receive the benefit. I gave you the premium or the price, and I'm uncertain on what's the benefit that I'm going to get. But when it comes to investments, I invested my money, and I'm uncertain whether I would make profit or not. But however, the terms of the investment are very clear. I contributed 10% capital. I will take 10% dividend, the 10% return, 10% profit share ratio. So all of this is clear. I mean, should be clear in the contract. But the
jalan-jalan di bawah.
All right. Okay. So how about JV? Let's say with non-Sharia compliant startup.
GTP. Okay. Should I address this or wait until the end of the session?
You can address, yeah, no problem.
Yeah. In JV, if you enter with a non-Sharia compliant startup in a JV, meaning that you don't enter as an equity holder or an equity partner, if the project that you're targeting is Sharia compliant, and you don't know for certainty that the funds used are Sharia non-compliant, then it should be allowed. Meaning that, let's say a non-compliant startup wanted to enter into a JV to purchase some chips from Thailand and sell it in Indonesia. In this case, I can enter as an individual or as a company. I can enter into a JV where we both contribute capital to purchase these chips and sell them in Indonesia. The subject matter of the contract is allowed. You buy and sell goods, and the money that the startup used, I don't know for certainty that it's coming from Sharia non-compliant funds. For example, it's not the proceeds of selling liquor. If let's say that startup is like into liquor business. That's it.
Okay. جزاك الله خيرا Mishal. الله يبارك فيك.